It's estimated that more than 70% of the wealth in this country is controlled by the baby boomers. Their number one fear as they reach retirement age, running out of money. So what can we do as investors preparing for retirement to ensure ourselves we built a solid retirement foundation? I personally feel the answer lies in the financial planning process, specifically understanding the critical ages of retirement planning. So today we're going to take you through those, beginning with age 50. If you've delayed saving for retirement, as a lot of folks have, the age 50 catch-up actually allows you to, as the name suggests, catch up on saving for retirement. So anyone age 50 or older can actually contribute an additional $6,000 into a 401k and another $1,000 into an individual IRA account. Fast forward 5 years to age 55. If you're someone who has saved well, you're interested in retiring at 55 or older, you can actually access your 401k account without a 10% penalty once you've separated from service from your employer. One thing to keep in mind, and this is important, if you decide to roll over your 401k to an IRA, the rules change. You can't access those funds without penalty until age 59 and a half, which leads me to that next critical age, 59 and a half. Again, no penalty to take money out from an IRA or a 401k. Just keep in mind, any withdrawals from these accounts are considered ordinary income and taxed in that fashion. So if you have additional income sources in retirement, this will be tacked on top of those income sources as a tax liability. So we've talked a little bit about your 401k, your IRA. What about Social Security? You can apply for Social Security benefits at age 62. However, if you decide to do this, the benefit amount you receive will be less than your full retirement benefit amount, and in some cases it could be up to a 30% reduction. Either way, this is a very popular age to claim. In fact, more than 34% of U.S. workers who retire take Social Security at age 62. Now at age 65, you're eligible to enroll in Medi-care. If you're not taking Social Security, you should plan on applying for Medi-care Part A and B. There is an open enrollment period that begins 3 months prior to you turning age 65 and extends 3 months past your age 65. In regards to Part B, this is a voluntary enrollment. So hypothetically, you do not have to enroll in Part B during your initial enrollment period. However, keep in mind that if you decide to defer this enrollment, you will actually end up paying a 10% penalty. This is called a Part B premium penalty for not enrolling. So that happens every 12-month rolling average. So say, for instance, you decide to not enroll in Part B for 5 years, that could actually turn into a 50% penalty. So it's important to enroll in both Medicare Part A and B. Now back to Social Security. When you turn age 66 or 67, depending on your birth date, this will be deemed your full retirement age. So at this point, you can take your benefit. There's no reduction whatsoever in Social Security, and that benefit is fixed throughout your retirement. If you decide to delay taking benefits past your full retirement age, your benefit actually increases 8% each year you delay. So for example, someone whose full retirement age is 66, you would actually receive 108% of your full retirement age benefit if you were to apply at age 67. This 8% increase continues until age 70, at which point there's no advantage to delaying taking the benefit. Retirees will no longer have to take required minimum distributions from traditional IRAs and retirement plans by April 1st following the year in which they turn 70 and a half. The new law generally requires RMDs to begin at April 1st following the year in which they turn age 72. The RMD change to 72 only applies to those that turn 70 and a half in the year 2020 and beyond. Those that turn 70 and a half in the year 2019 are still under the old rules. For your workplace retirement accounts, if you're still working and don't own more than 5% of the business you're employed by, you may be able to delay taking your RMD until April 1st, the year after you retire. Now, keep in mind, this rule does not apply to IRAs or plans with companies you no longer work for. So I'd just like to thank you for listening to this Retirement Readiness webcast. Be sure to subscribe to our channel and check out our other helpful retirement planning resources on our website at bfsg.com. If you have any questions, feel free to contact me at 949-955-3203. or email at keithj@bfsg.com. Again, thank you so much and have a great day.